All right, what is happening, everyone? Welcome back to another Dividend Happy Hour. Hope everyone had a great week. I am so stoked to be back with you guys for another live stream. I do got to tell you real quick before I forget and start rambling. This stream's going to be a bit short tonight. I think we're only going to run it about 30, 40 minutes, somewhere in that range. We have a very, very fussy baby over here. She's pretty good for the most part, but there's something in the water today. She is, like I said, she's being very fussy, and I just want to help my wife out a bit and don't want to leave her with that because she's been with her all day. I've been working. That's another thing too. It's been just a crazy busy week. We've got company coming this weekend, so I want to cut this stream a little bit short, 30, 40 minutes. Go help my wife with the baby and just spend time with them. So I hope everyone understands. There's Peanut. I did want to get that out of the way before I forgot, like I said, but we are going to make the most of our time. Let me see who we got in the building here. I'm going up in the chat. I see Korean Cardboard. I see Edwin's here. Joey, what's going on? Chris is here, and Chris started a new position, so I'm excited to find out what that is. Law's here. Glow is here. Mike, what's happening? Thomas, I made it to one finally. I know, finally, man. Good to see you in here. Yeah, Ryan must be changing a diaper. No, not too far off. Right before this, I was holding the baby, and like I said, she's just being a fussy Sue. That's what I call her. I call her Fussy Sue. I've got so many names for her already, but Fussy Sue is definitely one I've been using lately. And actually, kind of a fun fact: she's officially 4 weeks today, and that time is definitely flying by. Mike's here. What's up, Mike? Boaz is here. Aussie Dividend is in the building. Jay is here. Yes, first time watching the Dividend Happy Hour. Love it, man. I'm stoked to see you here in the live stream, and that goes for all of you guys, obviously. And for the rest of you, in case this is your first time tuning in, just so you know, we typically do this live stream every Friday night, starting like right now, 5 p.m. Pacific time, 8 p.m. Eastern time. It's always a good time, so if you enjoy this one, I hope to see you back next week and also in future live streams. And I apologize once again for cutting it short, but yeah, new responsibilities. It's definitely an adjustment. It's going really, really well so far, I will say, though. DJ Clark's in the building. What's happening? Joe Dirt. What's going on? Andrew Vasco. Who else we got? Phil's here. What's up, Phil? Anders is here. Yeah, baby is greater than Peanut, which is greater than us. Yeah, I love you guys, though. I really do. But it's tough. It's a tough competition, You guys are the best, though. Caesar's here. Alfredo, Fast Eddie. What's going on? David from San Diego. What's up? Good to see you, my friend. Yeah, well, thanks, Vasco. I really appreciate that. 30 minutes is still a luck to have you here. And I really wanted to do this too. I look forward to doing this live stream every single week. And I didn't want to miss it. You know what I'm saying? So I think 30 minutes, 40 minutes is a fair compromise. I say 30, but realistically, it'll be closer to 40 just because you guys know how we do it over here. Jack's here. What's up, Jack? Yeah, I was wondering if you can cover Canadian National Railway. We'll check it out. We'll add that one to the list. And if you guys have any stocks or stocks you want me to go through, any investing questions, drop them in the chat and we will start going through them here. Through them here pretty soon. Cool, Thomas. I'm glad I'm not the only one. Yeah, it's funny. So our daughter's name is E-L-L-E. And I think since she's been born, I've maybe called her actual name like once or twice. Otherwise, there's just been so many different nicknames. Like I've probably got, and it's the same thing for my wife. It's the same thing for Peanut. I've got probably 100 different nicknames for each of them. So Jose's here. What's up, Jose? Logan's here. What's going on, my friend? Shannon, what's happening? Adon is here. What's going on? Sissom. Yes, tomorrow's great question. Tomorrow's Deep End is live. So that's another thing, guys. I totally forgot about that. So tomorrow at 10 a.m. Pacific time, 1 p.m. Eastern time, Ari and I are going to be going live over on the Deep End channel. I shared a link to it over on my channel. Just check out the community page and you'll find the Deep End just from going to my channel too. But yeah, if you guys want to tune into that, it will be kind of just a continuation, a little Q&A. And yeah, would love to see you guys there. But that's tomorrow at 10 a.m. And I also have a pretty interesting video going out first thing tomorrow morning as well. I'm covering a stock that's just really, really tanked in the last year. It's down something like, I don't know, like maybe close to 55% at this point, and the dividend yield has been pushed up to 8%. So it's looking like a really interesting opportunity. This is one that actually my dad and I were talking about. He told me I should look into it. And so I made a video on it. I'll be posting that first thing tomorrow. Who else we got though? Bernard's here. What's happening? Yeah, Journeyman, thank you so much. Good to see you. Shane wants us to look at BKNG. That's booking, right? Okay. Yeah, Billy says Kenvue. So we'll start there. We'll start with those few, and then we'll see kind of what time we have left. Before we get into those stocks, though, guys, you know how we got to kick this thing off. Grab whatever it is you're sipping on. Cheers. Here's to you guys. Thank you so much for hanging out with me tonight for another Dividend Happy Hour. This is episode 152. Crazy that we've done so many of these, but cheers. Thank you guys for all the support on the channel. It really means a lot. And also here's to the dividends. Here's to the pursuit of that sweet, sweet cash flow, because that's really what's bringing us together tonight. So cheers. And I actually want to show you guys something. Yeah, Boise Cascade. We'll check. That's a good one. I want to show you guys a little something too. I'll be sharing more about this. Actually, a couple things before I get into the stocks. Number one, over here on my dividend portfolio tracking spreadsheet, which as always, you can download this for yourself and start using it to track your portfolio. There's a link to that in the description. But guys, I want to show you this. I don't know if I have shown you this yet, so I apologize if I have, but look at this annual dividend income. With the addition of Watsco to the portfolio, we have long surpassed the $3,600 income goal that I had set by the end of the year. So now we are officially averaging over $300 per month, now actually $317 with all that Watsco buying. And actually, I'm kind of spoiling something that I'm talking about in the future, but I'm thinking my goal by the end of the year, guys, this is going to be bold, so bear with me. I think my goal, let me hide this. I didn't realize that was up. My goal is $4,000 in projected annual income by the end of the year. I think we can do it. I'll talk more about that in the upcoming this upcoming month's portfolio update video, which is going to be going out like Tuesday or Wednesday. So anyway, I just wanted to show you guys that. And also a quick announcement, you guys, it is earnings season. All the stocks are reporting their quarterly earnings. And I've been working hard to try and get some notes out on at least the companies that I follow. So as you can see, I'm publishing notes on WP Carey, Rollins, Watsco, KRC, Visa, Badger Meter. Scrolling down a little bit more, pretty much Johnson & Johnson and up is everything from like this quarter. So these are all fresh. And on my list to go through still over the coming days, I will be also going through Vici Properties, Verisk, Enterprise Products Partners, AbbVie, and Chevron. Those notes will all be on the website probably by end of next week. I usually try and do a couple, 2, 3 per day if I can. But we have company this weekend, so I'm going to be a little bit slow. But anyways, if you guys want to check out all of these earnings notes, and I'll just give you a little sample of what it looks like. If you want to check this out, head over to my website, retirewithryan.com, go up to the read tab up here, and then go to stock research, and you'll see all the articles. I'll also link this in the pinned comment as well, so you guys have quick access to it. But as you can see, it's got links to transcript, presentation, the 10Q, all the important stuff, little overview, key takeaways, and then my full notes from the call right there. So like I said, I'm trying to go through as many companies as I can, at least the ones that I follow. And hopefully you guys find these helpful, and they're all over on the website. So I do hope you check them out. But with that said, let's jump over now to Snapstock. What do we have on our list here? We've got, yeah, looks like, and I'm sorry, I know I skipped the questions. I know I skipped the buy questions and, what you guys are sipping on and the milestones. That was not intentional. But I know if we start going through those, it's going to take up the whole time in the stream. So with the limited time that we have, I want to go through some of your guys' questions here, look up some of these stocks you guys want to cover. So we're going to start here with Jack's request. Let's go through CNI right here. And also with that said, I mean, obviously, I'd love to hear what you guys bought this week. So definitely share it in the chat. And I'd love to hear if there's any cool milestones in your guys' portfolio as well. So please drop those in the chat as well. I'd love to share in those accomplishments. I just probably won't be going through each comment because we got to get to CNI right here. So first things first, the stock is down 9.6% in the last year. Right off the bat, a couple things I'm noticing. Pretty decent snap score. Okay, most of the scores look good. Growth's decent, debt's but everything else, profitability, dividends, capital efficiency, strong scores. So all in all, this is an above average score. So we do like to see that. But what I was going to say is right off the bat, one thing I noticed is these valuation metrics are looking very strong. PE ratio is only 13 and a quarter, which is about 40% below the 5-year average. With that, the free cash flow yield is really high at 5.4%. So that's really good to see. And this is also 54% above the company's 5-year average. And with that too, the dividend yield's coming in at 2.6%. Maybe, pretty middle of the road dividend yield. But this is quite a bit above the average. So these few metrics, especially in relation to their averages, the PE ratio, free cash flow yield, and the dividend yield all kind of point to what could potentially be a discounted company. And we do see some other dividend highlights here. We'll go through them more in just a moment, but really low payout ratios and pretty solid dividend growth rates. So I think when you pair this 9.2% dividend growth CAGR with the 2.6% starting yield, I think those are pretty well-balanced dividend stats. So I like to see that. So scrolling down, getting into the growth section, what was the growth score real quick? Sorry. It was about 5.2, so middle of the road. Yeah, I think that makes sense. It looks like on the top line, we do see some consistent growth. It's not surprising that this wouldn't be the most aggressive grower. Railroads, very mature industry, very necessary industry, which I think is the draw to owning a company like this. Still, they are getting some good growth there. Earnings per share, it's had its ebbs and flows, it looks like. Little up and down. It looks like going into 2022, we do see a pretty consistent upward trajectory, but these last couple of years with the earnings per share have seen a bit of a pullback. I don't think that's the end of the world, especially when we zoom out over a longer period of time. The trend is still up. So earnings is still continuing to grow. And this is also pretty capital intensive business, a very capital intensive industry as well. So I'm sure that throughout the years, their costs are going to fluctuate just depending on what's going on in the business and what they need to do there. But looking at the free cash flow per share, kind of a similar train of thought. But I will say it does look like this chart is a bit more favorable, at least in my opinion, a bit more favorable than the earnings per share right here. Free cash flow looks to be pretty intact. So I think this all looks pretty good. Growth, it's not the most aggressive grower, but growth is still there. So I think that, middle of the road score does make sense. We do see some declining margins here a little bit on the bottom line over the last handful of years, going from, looks like about 30% in 2018 down to 26% in 2024. Similarly, it's had its ups and downs, but the general trend does look to be down. We do see that a little bit here with the free cash flow margin too. So, excuse me. Not the end of the world, but once again, just something to keep an eye on. Now, interesting. I think debt was the lowest score, right? We saw, let's see, it looks like debt was 4 out of 10. So yeah, not the best. We do see the net debt going up throughout the years, actually quite aggressively, going from 12 billion to 21 billion in 2024. And I don't know enough about the company to know the cause of this jump in debt. So maybe you guys can shed some light on this in the live chat here if you have any insight. Okay, so Chris, I'm sorry, man, I forgot to ask, but new position is Meta. Good stuff. Goodbye. Yeah, I don't know the exact number, but they saw a pretty substantial pullback from reporting their earnings, right? It's so interesting to see that too, because I know they reported some like objectively pretty strong numbers on the top and bottom line. I don't know where they were in relation to the analyst estimates, but like pretty solid year-over-year growth still. And it's always interesting to see that happen and then see the stock go down. There was one company recently. Oh gosh, who was it that I took notes on them? Rollins. Who was it? It could have been Rollins. I think it was Rollins. So yeah, so Rollins posted pretty good earnings, and the share price went from like 57 all the way down to 53. Russ and I were talking about it, and then like the next day it jumped up 7% and got back up to where it was. It's just so strange. But anyway, getting back to CNI, decent increase in the net debt, and simultaneously we do see an increase in the net debt to free cash flow, which does make sense because during these years right here, if we scroll back up to the growth chart, free cash flow was pretty stagnant. So if debt's increasing, but free cash flow is not increasing as well, or staying stagnant, really good with words, as you guys can tell. anyway, with that combination, this is a recipe for an increasing net debt to free cash flow. And kind of my threshold for this metric is I like to see the net debt to free cash flow at about 5 or below. The rule of thumb is really the lower the better, but once you get to about 5, that's kind of where I start to get a little bit dicey for me. So we see this at about 6.7. Either way, it's definitely above that threshold, and interest coverage has been declining over the last decade. This is something I don't like to see. It's not completely terrible now. Kind of my threshold for this metric is 8 or above, but the general rule of thumb is the opposite of the net debt to free cash flow. When it comes to interest coverage, really the higher the better. And so it's not necessarily so much this number that bothers me, because 7 is still acceptable. It is below the 8. It could definitely be worse. It's not necessarily this objective number that does it for me. It's really the trend. The declining trend is not something I really like to see. And as we can see, this 7 in 2024 is quite a bit below the 5 and 10-year averages. So I think the debt picture is getting a bit worse over time. So that will definitely be something to keep in mind with this one. Let me take a sip of Joe. Yeah, Casey, I'm looking at the chat. Casey's General Store is an awesome company. Really like that one. That one's on my watch list, and I would love to see that one just tank. My brother-in-law, actually, he's him and my stepsister live in Nebraska, where they actually, I think they have Casey's General Stores out there, and I think that's how he found out about it. But anyway, one way or another, he has Casey's General Store in his portfolio and has for like a few years. And I'm just so jealous because his position's probably up multiple hundreds of percent at this point. So he's crushing it with Casey's. But anyway, back to CNI. We already established the dividend yield, 2.7%, and clearly it's a bit above the average. The 5 and 10-year average yields are less than 2%. So yeah, quite a bit above that. Very consistent dividend growth history. At the top, it said about 30 years. And I'm guessing that maybe in these years right here, these big jumps that we're seeing, no, I was going to say they're special dividends. They might not be special dividends, though. Usually on these charts here on Snapstock, that's what it indicates, but may not be the case here. Nonetheless, very consistent dividend growth. The earnings payout ratio, I think we already talked about this. Both the payout ratios are still in good shape, about 50% each. Looks like the free cash flow payout ratio is increasing. So, there is that, but it's still not in a bad spot. Still plenty of dividend coverage, and they're buying back shares like it's nobody's business. So that's great. Let me see. Oh, nice. My wife is from Kansas and my in-laws own it. Very cool. Talking about Casey's. So anyway, that's Canadian National Railway right there. What do you guys think about this one? Any of you own this stock out there? Does this one look interesting to any of you at all? What do you think about this company right here? Decent snap score, decent growth, still generating a lot of cash flow, well-covered dividend, consistent dividend grower, bit high debt. But what do you think about this one? Let me know in the chat. See what you guys have to say, and we'll jump over. Next up, we got, I'm glad we're only looking at a few companies because I'm not going through them super quick, trying to be thorough. Aussie Dividend says, doesn't look too bad, but not interested. Yeah. Yes. This is a quick question. What is your opinion about some things that happen in the market, like PayPal that has good earnings and they declared a new dividend, which is very cool to see. I think I saw that their starting yield is going to be maybe 0.75%, which is great. Good job. But anyway, what do you think about that? And in one day go from 70 to 80 and then 80 to 70? Could it be people trading? Yeah, it definitely could. I think that there's a number of things that have an impact on the share price. Just trading in and out is one of them. Maybe some people entered because they like the earnings news. Maybe some people exited the next day because they're taking profits or don't like the dividend news or weren't happy with the earnings. I mean, truth be told, I don't have a serious opinion about the share price move, and especially like in the short term, because in most cases, it's going to be driven just by how people think about the stock or about the company right there and then in that moment, which is typically not something I concern myself with too much. At the end of the day, looking at the share price, what you should be concerned about is whether it's low enough to warrant a buy, in your opinion. And so, if it jumps from 70 to 80 and then back down from 80 to 70, it's just because for whatever reason, other people are buying it and selling it, and they're going to have their various reasons for that. The people who are buying it think the company's best days are ahead of them. Generally speaking, the people who are selling it think that their money is better put elsewhere. And so I think if you are a shareholder of PayPal or a prospective shareholder, just decide which camp you're in. So it really just comes down to what you think about the company. So, Amir, that warms my heart, my friend. This guy's my guy. This stream actually brings me joy. That's awesome. That's if I can do that, if I can just do that and nothing else, then I'm happy. I've done my job. So, yeah, maybe we'll take a look at Kenvue 2 real quick. Okay. So let me just add this one because I've seen a couple of you guys mention Kenvue. And I've gotten a few comments about it. So we'll go through it really, really quick. These next few, we're going to go a bit quicker than, I already had Kenvue on my list. These next few, we're going to go a bit quicker than the last. Okay, let's get to it. Okay, Booking Holdings, BKNG, are they a dividend payer? I think they are, right? I think they let's go over here. Yeah, so they do have a dividend. There we go. Okay. So I know that there's been a lot of chatter about this stock lately. Ari is actually a big fan of this company. I don't think he has the stock or anything like that, but he's a big fan of them as a customer, as a user of their platform, because we talked about it somewhat recently. But anyway, in the last year, they're up, about 7%. Looks like since, I don't know, I guess since July, it has kind of started to trickle down. But interestingly, PE ratio is 33, a bit high, but I think it's a bit of a growthier company. We'll look at the snap score in a moment. Free cash flow yield is pretty high too, though, 5%. I like to see that. So it could be at a good valuation based on the free cash flow yield. And even with the PE ratio at about 33, I wouldn't let that deter you if this is going to be a growthy company. And from what we're seeing here, 6 out of 10. To be honest, not as high of a growth score as I would have expected to see based on the PE ratio, but I don't know. We'll look under the hood and see what's happening. Everything else looks pretty good except for capital efficiency, but we'll see. Maybe that's just a snap stock issue. So, okay. So with growth, I think, yeah, this is interesting. So 2020 was obviously a tough year for this company. And that's why this blip right here from top to bottom, 2020, 2021, basically this actually 2020 to 2022, which is, I guess, like a recovery period for them from the COVID stuff. Minus that, you're getting a really high growth score. And even with that, I mean, over the last 5 years, growth's been 37%. Over the last 10, it's been 11%. So I think the growth charts here look a lot better than what the score is indicating. I like that. Very high margin business. Obviously, it's just a website. It's a travel booking platform. So not going to be super capital intensive. Crazy high margins. Yeah, debt's pretty dang low. They do have some debt. They have about $1 billion on the balance sheet. But based on this, because the net debt to free cash flow is less than 1, they're going to be bringing in more cash flow every year than they are generating. No, let me rephrase that. They are generating more free cash flow every year than they have net debt on the balance sheet. So debt is effectively not a big deal. Even with this interest coverage pretty low right here, I just don't think that that's really much of a concern. I mean, they can pay this debt off tomorrow if they want to. So I think the debt situation looks fine. So far, the dividend growth, I don't know. We'll see. We'll see how it shapes up over these next couple of years. But it does look to me like this company has a lot of the makings to be a dividend growth stock, akin to what will probably end up being the case with Alphabet, with Meta, probably with PayPal now. Salesforce, you could probably throw in it. It's probably going to be pretty similar to that. And honestly, like a Visa as well. Like think of Visa's dividend profile, low starting yield, consistent like double-digit growth. I think that's probably what we'll get from a lot of these tech companies. And no surprise, the dividend's very well covered. They're buying back shares like it's nobody's business right now. And actually the share buyback CAGR, I guess, is the right phrase for it. It is extremely high. They're buying back almost 5% of their shares every single year on average. And you pair that with the starting yield of 0.7%, you're getting a total shareholder yield about 5.5% right there. And I don't know why the capital efficiency score is so low. Maybe because these returns on equity are negative. Sometimes that happens. Like if you look at Domino's, by the way, I think Domino's is one. Domino's is one. Starbucks is one. They're going to have negative returns on equity as well. And typically you'll see that pretty commonly with companies that are buying back a lot of their shares, like Booking Holdings is. So the negative return on equity does not concern me. And the return on invested capital is just insane. Like in the most recent year, it's 44%. It's just, yeah. So it's got a lot of makings to generate some really solid returns for shareholders. And based on the free cash flow yield, 5% free cash flow yield might not be a bad one to consider. So, ooh, the FMC meltdown. What is that? FMC? No. What is this, guys? What do we got? Holy cow. Oh my goodness. Okay, we're going to have to see what's up with this. Actually, you know what, guys, I want to do? I want to show you something new real quick. Okay, so I actually just got emailed today from someone at Google, which is the first time that's ever happened, by the way. That was like the coolest thing ever. I actually got an email from someone at Google sharing some information about just the new updates they're making to Google Finance. This is the beta, as you can see right here. And if you go to google.com/finance/beta, you should get access to this. And so what do I want to do? I want to look up FMC. So if we look up the stock, and basically just as a sidebar, these new updates to the beta just are including more AI, but they're also adding features and functionality to listen to the earnings call. So like right here, if we go to the Q3 2025 earnings, you can actually listen to the call right here within Google Finance. You can get all the documents, 10Q presentation as well, which is super handy. So let's see if we can get some insight on what exactly happened. So earnings per share beat despite revenue miss. So, okay. So they reported a net loss, okay, of 452, missing the expected revenue. Okay. And then revenue was down. Okay. So they missed revenue by about 50%. Revenue came in at 542 million, but it was expected to be just over 1 billion. Okay. That's quite a big miss. Adjusted earnings per share of 89 cents did beat though. So I wonder what the adjustments for, okay, mainly due to costs associated with the sale of its India business and higher adjusted EBITDA performance from cost controls and pricing. So I'm guessing, oh, okay, I see. So the sale in the India business, the divestiture, was why the sales came down so much. Okay. Although adjusted EBITDA grew 17% year over year. Oh, okay. Here we go, guys. So the company reduced its quarterly dividend to 8 cents per share to prioritize debt reduction and lowered its full year top and bottom line guidance with negative free cash flow forecast for the year. So, okay. Interesting. So I don't really know anything about this company. Excuse me. I don't know what this company does at all, but this doesn't seem like good news at all. And the cool thing about this too is we can click on these and it'll give us some more color on like maybe what this means for the company moving forward. I'll probably start using this more often. Yeah, there's actually some really cool time-saving tools coming out right now for investors that does a lot of this. There's a like a stock news platform I'll be telling you guys about coming up here pretty soon. That's really cool. Just aggregates a ton of news. You can build a custom watch list and it will summarize all the news for you, give you the bullet points, give you the key takeaways. And I've been using it a lot lately and it's been a huge time saver. So I'm really, once again, I've said this so many times, but we are so fortunate to live in a time where we get access to these great tools, like things that investors didn't even have 10, 20, 30 years ago. What a time to be an investor. But anyway, back to FMC. Not great. Definitely not great. Do not like the dividend reduction, but I do like that they are going to be reducing their debt load, which once again, I don't know anything about this company. I don't know about where their debt is even to begin with, but I am all for reducing leverage and cleaning up the balance sheet. So I wish them well. Wish them well. I think Amir is, if you're asking about a Discord, if I have a Discord, yes, there is a link to it in the description of the video. Definitely check it out. It's free to join. Okay, guys, so let's jump over. We have 2 more stocks to look at. We'll go through them quick. I say that, but then I start rambling. This next one's going to be Kenvue. Billy wants to know about it. Adam wanted to know about Kenvue. And like I said, I've been getting a lot of comments just on my videos about Kenvue. And I feel like this one gets brought up from time to time. Maybe I need to do a full video on Kenvue, because it really has, like, every time I look at this stock, it gets cheaper and cheaper. And just for a little context on Kenvue, this was the company that spun off from Johnson & Johnson in, well, basically not too long ago. But this is their consumer products company, or was their consumer products division that, once again, they spun off into its own. And this owns brands like Tylenol. I think Motrin's in there. You've got Listerine, other stuff like that. So I don't know the full list off the top of my head, but those are a few of the heavy hitters. But yeah, like I said, it just seems to get cheaper and cheaper over time. And it's really not had a great year. It's down 36%. With that, the free cash flow yield is really high at about 6%. PE ratio, 19.4, which actually isn't too bad of a PE ratio. And I'm not really going to pay attention to these 5-year average changes, because this is a pretty brand new company. So we don't know what the average is really. So yeah, and every time I look at this stock, I am reminded why I don't feel the need to have it. And this is why, because as a Johnson & Johnson shareholder, you got shares of Kenvue during the spinoff, or once the company spun off, and you could obviously hold on to them, buy more, sell them, whatever you wanted to do with them. I sold mine, and I'm really glad that I did, because the share price has tanked. But it's just the revenue growth. It's there, but it's like almost nothing. It's less than 2%. You shouldn't really expect crazy growth from a company like this anyway. But even so, this is lower than something you'd see. This is lower than what you'd see from something like Procter & Gamble, for example, whose growth is a bit higher. I think Colgate-Palmolive probably has higher growth as well. Actually, charts pretty similar to what we saw with Procter & Gamble. Kimberly-Clark, maybe. We'll see. Not really. So Kimberly-Clark's actually pretty flat as well. But yeah, Kenvue, top line growth, really not great. Bottom line, earnings per share and free cash flow per share have pretty much done nothing but go down since the company spun off. So, that's not looking too good with that. I mean, for me personally, I probably wouldn't consider it beyond here, just because there's other companies that have better earnings per share growth, better free cash flow growth. I just, like Procter & Gamble's just prime example. I just would feel so much better about owning that company. Do feel much better about owning that company. High starting dividend yield, though, which I think is maybe where the draw is. So starting yield of 5.6% in the trailing 12 months. It's probably a bit higher on a forward-looking basis, but still pretty respectable starting yield. So I think that's really what's making it enticing right now. But, this dividend, it's poised for a cut. Okay. I mean, the payout ratio has been above 100% for these last couple of years. Same thing with the free cash flow payout ratio. So I don't know. I don't really see the draw to investing in this stock beyond just the dividend yield. So it's not one that I'm personally interested in owning. Let's see. Yeah. Okay. So let's go through one more, guys. And we do have to wrap it up, unfortunately. I'm going to go a little bit over. It'll probably end up being about 45 minutes, but we'll still get out a little bit early. This last one we got to look at for David. This is BCC, Boise Cascade. It's been a while since I've looked at this stock. From what I remember, though, it's a pretty solid company. Like, the financials are going to look pretty good. From what I remember, too, they actually don't have any debt. I could be wrong about that, but let's see. Let's find out what's going on. So in the last year, BCC has seen a crazy drop. It's down 47%. Um, pretty nice valuation stats, right? 10.3 PE ratio, still a bit higher than the starting yield, or still a bit higher than the 5-year average, excuse me. Free cash flow yield's 4.3, not bad. This is lower than the 5-year average. So maybe based on these, what we'll see is a reduction in earnings per share and free cash flow per share. Let's see what happens. Snap score's not bad. Growth doesn't look too great based on this, though. Profitability is low. That's not all too surprising, though. This is a company in the industrial sector. I'm not going to get it completely right, but they work in lumber and molding. So I would imagine that's pretty capital intensive. So it doesn't surprise me to see low margins. Everything else looks good, though. Like debt's at 8 out of 10, perfect dividends and buyback score, and solid returns on invested capital, probably. But let's scroll down and look. So yeah, sure enough, since 2022, it's really dropped off a cliff. The earnings per share has, and the free cash flow per share has as well. Sales have even too. So sales have held up better than the other two, though. So yeah, margins have gone down along with that. No, pretty much no debt, though, right? So that's good. They're still generating more in free cash flow than they have in net debt on the balance sheet. Interest coverage is still very high, so debt at least doesn't look to be an issue. And some interesting dividend stats here. I'm wondering if maybe there were some special dividends in here, and that's what we're seeing. You'd have to go and look, but that's my guess. There's probably some special dividends in here. So, wow, is the yield really 8.25%? I don't remember the starting yield being that high. From what I remember about this company, and it's been a long time since I've looked at it, but I thought the yield was like less than 1%. Is it really that high? No. So what is this? What is this right here? Something is not right. Okay. So we're going to go by these numbers here. Yeah, that's crazy. Okay, so at least the profit numbers and free cash flow numbers are still in line. So okay, so I don't know why the dividend stats are off for this one. My apologies, guys. I'm glad that we have this to cross reference. But anyway, with the dividend stats, the starting yield's 1.25%. So yeah, that's more what I was thinking. According to this, the dividend still is very well covered with a 12.3% payout ratio. Solid dividend growth over the years, 16.25%. So I think these dividend stats are really good. The big question about this company, obviously, debt's not an issue. Dividend stats are looking good. What's it going to take for them to get back to growing the sales? I mean, sales and profits and free cash flow. A couple years of pullbacks, not really a huge ordeal. And I would imagine that this is a pretty cyclical business. And this is also a pretty tough business. I don't know exactly what they do in the. Let me see if maybe it'll tell us. I don't know exactly what they do in the molding space or the lumber space. So they manufacture and sale of engineered wood products. Okay. And building materials distribution. So they're a manufacturer and a distributor. I do know a lot of molding and lumber does come in from overseas. It's just so much cheaper to get it in like Latin America and stuff like that. And so it's kind of hard to compete as a US based lumber molding company. But yeah, it looks like they take maybe just the raw materials and then make their own molding out of it. Their own lumber. So they make their own products out of it. Maybe get like I said, the raw materials overseas and then distribute it from there. I'm just trying to think out loud and piece it together. So, I just don't know enough about this company or this industry to really have a good opinion on it, but it's seen a crazy pullback. I am concerned about the trajectory of the earnings and the free cash flow. The dividend looks pretty safe for now. I mean, it looks totally safe. I don't know what I'm saying there, but yeah, the dividend still looks very safe. Like even with the pullback in earnings per share in the trailing 12 months, less than $7, they're still only paying 84 cents per share in dividends. So it's like this company's just not at risk of cutting their dividend. Ooh, that's not good though. Negative free cash flow in the trailing 12 months. Prior to that though, same story. Like dividends very well covered from based on the free cash flow. So I don't know. I don't exactly know what to make of this one. It's got some good aspects to it. It's got some bad. Like I said, I don't think the dividend is at risk of being cut. So if that's well, it should be something you're concerned about. But if that's one of your things with this one, that doesn't look to be a concern. It's just the earnings and free cash flow for me. That's it. So let me see. Let me get caught up here. Let me get caught up here. Yeah, Trevon, I think Hershey's a great looking company. Let's see what else you guys say. We'll probably wrap it up in just a minute. Excuse me. Eric, that's funny. That's a funny comment. Funny. Okay, looks like you guys are just talking about the Hershey company. Nathan, so I've seen a couple of you guys mention UPS. Here, if you go over to, let me show you something. I actually did a full video on UPS last month, and I'll show it to you. If you go over to, here, let's jump over here. If you go over to the channel, okay, go over to the channel. If you scroll down here to about a month ago, you'll see this video. Right here, I did a full breakdown on UPS, so I highly recommend checking that out. That should answer hopefully all of your questions about EPS. So, is that true? I didn't. I haven't kept tabs on Altria. That might be sarcasm, because from last I checked on Altria, the share price was like up. Like I probably should have held on to it a little bit longer. Waiting for Seeking Alpha to load. Let's jump over to Snapstock though and see what's been going on with Altria. Last I looked at Altria, it was like $60 something per share. So now, oh wow, okay. So they must have just reported earnings. I did not catch this. Okay. I'm glad we're looking at this. Interesting. Yeah, since I sold it, and I have a tendency to do that. Once I sell a stock, it kind of, in a lot of cases, it becomes out of sight, out of mind for me. Starbucks is one that I'm still keeping tabs on. Seeking Alpha has been doing this to me lately, guys. I don't know if this ever happens to you too, but like, oh my goodness, it will just take so long to load sometimes, and I don't know why. Well, I feel, at least for now, I feel vindicated about Altria. And I will say, like, Altria was nothing but good to me. Where did I sell it? I think I sold it around where the current price is. No, I sold at 59. Okay. Sold at $59 a share. Okay, so that's good. That's good. Yeah, Starbucks, I think I timed that one good, at least so far. Southern Company, oh gosh. Yeah, I should have held on to that one. So let's see what's up with Altria. I keep saying this, guys, but this is it. Then I've got to go. Okay, so man, there's so many videos, so many stocks now that I feel like I need to do a video on. Kenvue, Altria. Okay, but they're raising guidance. Earnings per share. So that's the thing about Altria. It's like the sales have continued to go down, which is not surprising because, I mean, as we'll see in the charts, where's the smokables? So smokable actually not bad. Down 1% year over year, but you know, it's going down over time. Wow, big drop for Marlboro. Yeah, volumes are going down. So they're really making up that up with price. So anyway, what I was trying to get at though is the thing with Altria is like the earnings per share, ever since I owned it, the sales, I mean, it kind of looked like this. The volume looked like this, just continuing to go down. No surprise. But then the earnings per share kept going up. Like they did continue to improve the bottom line. And also like the free cash flow is still pretty intact. I mean, the free cash flow is still going up. You know what I'm saying? So from a dividend investing standpoint, I still think it's would have been a good one to hold if you're looking to collect that just consistent growing income. And I still think they will continue to grow the dividend. And as we can see, like they are becoming more efficient in the financials because the margins just continue to improve, even though the sales are going down. So it's not all bad with Altria, but as Russ said, as Russ has said numerous times, like he says it best, it really is a melting ice cube. So very, very slow melting ice cube. But that's ultimately why I decided to sell out of it. I wanted to, I just wanted to put money in something, in a company that was actually growing. And yeah, you can make up for lost sales and by becoming, working on, how do I say this? You can make up for the declining sales by improving everything else, by becoming more cost efficient. You can do that, but that's only going to work for so long. There are only so many costs that you can cut. And at a certain point, it was going to come to a head for Altria. So I just felt I should quit while I was ahead. We'll see. I mean, if they ever get things figured out with the vaping stuff, I wouldn't mind buying back into it. But for now, I'm good being out of it. Yeah, Caesar, you're right. It is time to go, my friends. Stayed a little bit late as it happens. And I'm sorry I had to cut out a little bit early, but I do want to thank you guys so much for your time tonight. Definitely jump on to that Deep End live stream tomorrow. Once again, that's going to be tomorrow at 10 a.m. Pacific time, 1 p.m. Eastern time. If you want to find the link to the live stream, just head over to my channel, go over to the community tab, and you will see the link to the Deep End live stream for tomorrow. But I hope to see all of you guys there. For those of you whose questions I did not get to tonight, please tune in to the live stream and ask them tomorrow, because we'll be just going through your guys' questions in that episode, and I'd love to chat with you guys. So yeah, Caesar, forgot to mention my wife picked up the Retire Often book. Nice. I'm about halfway through it, so I hope you guys enjoy it. But you guys all have a great night. Happy Halloween. Stay safe out there, and hopefully I will see you in tomorrow's live stream. If not, guys, I'm putting out a great video tomorrow morning. Really interesting stock going out first thing tomorrow morning. Please tune into that. Drop me a comment and let me know what you think. But otherwise, hope you have a great weekend, and I will see you in the next one.